Hey there, everyone. Welcome back to our channel. If you're new here, I'm your name, and today we're diving into a topic that might seem a bit complex but is super important for anyone dealing with investments: capital gains taxes. Whether you're buying stocks, real estate, or even collectibles, understanding how capital gains taxes work can help you make smarter financial decisions. But first, let me ask you, have you ever sold an asset for more than you paid for it? How did that make you feel? Excited, right? But then you might have wondered, wait, do I have to pay taxes on that profit? Well, let's break it down. So, what exactly are capital gains? Simply put, capital gains are the profits you make from selling an asset for more than you bought it. This can include stocks, bonds, real estate, and even personal items like cars or art. Now, capital gains can be classified into two categories: short-term and long-term. Short-term capital gains are profits from assets held for 1 year or less. These gains are taxed at your ordinary income tax rate, which can be as high as 45% depending on your income bracket in the UK. For example, let's say you bought 10 shares of a tech company for £100 each. After 6 months, you sell them for £150 each. Your profit? That's £500. Since you held those shares for less than a year, you're looking at a tax rate that's the same as your income tax rate. If you're in the 20% basic rate bracket, you'd owe £100 in taxes on that gain. Ouch! On the other hand, we have long-term capital gains. These are profits from assets held for more than a year. The tax rates for long-term capital gains are usually lower, ranging from 18% to 24% in the UK, depending on your income and asset type. This is a significant reason why many investors try to hold onto their investments for at least a year. Let's say you held onto those same shares of tech stock for 2 years instead. You still sold them for £150 each, pocketing that same £500 profit. If you're a basic rate taxpayer, you'd pay 18% on your long-term capital gains, which would reduce your tax bill to just £90. That's quite a difference. Now, it's also important to know that not all assets are taxed the same way. For instance, collectibles like art or antiques are considered long-term capital gains but are taxed at a maximum rate of 28%. So, if you sold a painting for a profit, you'd be paying a higher tax rate than on stocks. But here's where it gets interesting. There are ways to potentially reduce your capital gains tax bill. One common method is called tax loss harvesting. This involves selling an asset that has lost value to offset the gains you made on other investments. Essentially, if you had a capital gain of £500 but also sold another investment at a loss of £300, you'd only pay taxes on a net gain of £200. Additionally, if you're looking at real estate, there's a special rule called the principal private residence exclusion. If you've lived in a home for at least 2 of the last 5 years before selling, you can exclude up to £250,000 of capital gains from your taxable income. This can be a game changer for homeowners. Finally, let's not forget about retirement accounts. If you invest in a tax-advantaged account, like a SIPP or an ISA, you won't owe capital gains taxes on investments within those accounts until you withdraw the money, if you ever do. So, to wrap it all up, capital gains taxes are a crucial aspect of investing that can significantly impact your financial outcomes. Remember, short-term gains are taxed at your ordinary income rate, while long-term gains enjoy lower tax rates. Always consider holding onto your investment for over a year when possible to maximize your profits and minimize your taxes. If you found this video helpful, please give us a thumbs up and consider subscribing for more educational content on finance and investing. And remember, knowledge is power. The more you understand about taxes and investing, the more you can keep your hard-earned money working for you. Got questions or topics you'd like us to cover? Drop them in the comments below. Thanks for watching, and see you in the next video.